Here's a question nobody on crypto Twitter is asking, but every institutional compliance officer has to answer before their firm deploys a dollar of capital. The question is not, is this legal? The question is, can I prove to a regulator in 3 years that it was legal at the time we made this decision? That is a fundamentally different question. And the gap between those two questions is the precise reason that Ripple winning a court case in 2023 did not open the institutional floodgates, even though the crypto community expected it to. Understanding that gap is the key to reading everything happening in Washington right now with completely clear eyes. Before we get into it, the standard note: I'm not a financial advisor. Nothing here is a recommendation to buy or sell anything. And I'm going to be precise about what is documented versus what is directional reasoning. Those are different things, and I'll label them clearly. Let's start with the mechanism that most coverage on this bill skips entirely. There is a concept in institutional finance called regulatory risk premium. It is not the risk that something is illegal. It is the risk that the legal interpretation will change. A court ruling tells an institution what the law means today, according to one judge in one circuit on one set of facts. A statute tells an institution what Congress decided the law means, permanently, for all similar facts across all jurisdictions. For a pension fund managing its compliance documentation, those two things are not interchangeable. A court ruling is a footnote in a risk memo. A statute is a citation. And that difference in institutional documentation is worth billions of dollars of deployment velocity because compliance departments have to justify every allocation to boards, auditors, and regulators who will review those decisions for years after they are made. This is the single mechanism that explains a puzzle most XRP holders have been frustrated about for nearly 2 years. The SEC dropped its securities classification appeal in August 2025. The CFTC formally classified XRP as a digital commodity in the months that followed. The court outcome was as favorable as anyone in this industry could have designed it. And yet, the institutional deployment everyone expected never quite arrived in the way the early thesis suggested it would. Exchange inflows from registered investment advisors stayed measured. The custody infrastructure expanded, but cautiously. The reason was not doubt about the outcome. The reason was that a settled case and a formal agency classification are both things that can be revisited the moment the political composition of those agencies changes. A statute passed by Congress and signed into law is a different category of permanence. It does not care who sits at the SEC or the CFTC. It does not expire with an administration. It is the law until Congress changes it, and changing law takes more political will than changing agency leadership. Institutional compliance departments know this distinction viscerally because they have watched agencies reverse course on guidance that institutions had built entire business units around in several different sectors multiple times over the past 2 decades. Now let's make the mechanics concrete, because the math behind why statutory clarity matters for this specific asset class is genuinely interesting and almost never explained properly. The IMF published a working paper last month with a number that deserves more attention than it's gotten. Global cross-border payment flows approached $1 quadrillion in 2024. JP Morgan's own Investor Day data, published this year, shows the firm alone moves over $12 trillion daily across 60 million transactions in approximately 120 currencies. FXC Intelligence, one of the primary data sources for this market, puts the total cross-border payments market at $194 trillion in 2024, projected to reach $320 trillion by 2032. These are the actual flows the correspondent banking system is processing. And every dollar of that volume, every single one, has to move through the Nostro and Vostro account infrastructure we've discussed in earlier videos. The $27 trillion in pre-funded zero yield capital that sits trapped in foreign bank accounts specifically to make sure payments can clear when they need to. Here is what the Clarity Act changes about that specific mechanism. Under the current framework, a bank considering whether to use XRP as a bridge asset for cross-border settlement has to weigh a very specific compliance question. What is the regulatory classification of the asset we are using, and what documentation do we need if that classification is challenged in a regulatory exam in 2028? Under a statutory framework where XRP is formally defined as a digital commodity used for settlement, that answer is a one-line citation to federal law. Under the current framework, even with the court outcome and the CFTC classification, that answer is a multi-page legal memo that has to be refreshed every time a regulator sends a signal that interpretations might be shifting. For a Treasury Department processing $50 billion in cross-border flows daily, the compliance cost of the second version is not trivial, and it is enough to keep decision makers choosing the path of least regulatory documentation resistance, which is currently the correspondent banking system they already have documented and approved. This is why the Clarity Act is not primarily a crypto story, it is a plumbing story. The technology on the XRP ledger settles in 3 to 5 seconds at a fraction of a cent per transaction. That is not in dispute by anyone with direct technical knowledge of the network. The question has never been whether the rail works. The question has been whether the legal document trail that institutional compliance requires is clean enough to use the rail. A statute cleans that trail in a way that a court ruling cannot. And that distinction is the entire institutional adoption thesis in one sentence. The closest historical parallel worth understanding here is how the U.S. money market fund industry evolved after the SEC formalized Rule 2A7 in 1983. Before that rule, money market funds existed and worked, but their use by institutional treasury departments was limited by exactly the same compliance documentation problem. Risk managers could not easily certify to regulators that these instruments fell within their approved investment mandate. The moment Rule 2A-7 created a formal statutory and regulatory framework defining eligible securities and required maturity limits, institutional adoption accelerated dramatically because the compliance citation existed. The rule did not create the product. It created the paper trail that risk committees needed to approve using it. The technology being cited in that case was considerably less impressive than a settlement network that moves value in 3 seconds. But the compliance mechanism was identical. Clarity Act passage would be the Rule 2A-7 moment for XRP Ledger institutional settlement volume. SWIFT itself recognizes this competitive pressure. The organization just launched a new cross-border payment scheme this year, building an MVP with more than 40 participating banks to bring consumer and SME payments to guaranteed arrival standards for the first time. And SWIFT has been quietly layering a blockchain-based shared ledger into its infrastructure, not as a cryptocurrency system, but as a coordination layer for tokenized deposits and central bank digital currencies to move through the same operational frame banks already used for fiat messaging. The incumbent is not standing still. It is modernizing precisely because the alternative rails are demonstrably faster and cheaper, and the only durable reason to stay on the existing system is the compliance documentation advantage it currently holds. The Clarity Act narrows that advantage to nearly zero for XRP-based settlement. Now let's talk about the competition because this is the part most XRP-focused coverage is not engaging with, honestly. The Clarity Act does not exist in a world where XRP is competing only against the old correspondent banking system. It is competing against every other chain and stablecoin that is also racing to be the preferred settlement layer for institutional finance. Ethereum holds 52.8% of the global tokenized real-world asset market at $17 billion. Stellar processes its own significant cross-border volume through its existing bank partnerships, several of which overlap with Ripple's. Swift's shared ledger initiative could, over time, provide banks with a settlement option that does not require any cryptocurrency intermediary at all, using tokenized fiat deposits directly. Visa is settling stablecoin transactions across 9 blockchains at a $7 billion annual run rate, growing roughly 50% in a single quarter. Here is what the XRP ledger's own data shows about where it sits in that competition right now. Over the past 90 days, the XRP ledger recorded $1.9 billion in net real-world asset inflows, the highest of any blockchain network globally, according to RWA.xyz, ahead of Ethereum's $1.6 billion and Stellar's $1.4 billion. RLUSD, Ripple's dollar stablecoin, has now surpassed the amount of RLUSD on Ethereum in on-ledger market cap, and its 30-day transfer volume grew nearly 91% in a single month. The network's total represented asset value crossed $5 billion, earning a top 5 global ranking in RWA issuance. These are not projections. These are current production metrics generated during a period when XRP's price was near multi-year lows and the Clarity Act had no scheduled floor vote. Institutional capital is moving on to this infrastructure regardless of where the Senate's legislative calendar stands. That is the most important thing the current numbers tell you. The XRPL lending protocol also just entered its final governance vote with XLS 65 and XLS 66, the 2 amendments that would add native institutional credit infrastructure to the network, currently at roughly 20% validator approval. The 80% threshold for mainnet activation means there's real work remaining, but the protocol cleared a Halburn security audit, has a $200,000 bug bounty open, and is live in DevNet for institutional developers to build integrations against before mainnet. That 4th stage in the network's architecture, representing, moving, trading, and now financing value, is the step that converts the $5 billion in represented assets from static inventory to active working capital. And it is in final pre-activation development right now, simultaneously with the most consequential legislative window this space has seen. The XRPL lending protocol also just entered its final governance vote with XLS 65 and XLS 66. The 2 amendments that would add native institutional credit infrastructure to the network, currently at roughly 20% validator approval. The 80% threshold for mainnet activation means there's real work remaining, but the protocol cleared a Halburn security audit, has a $200,000 bug bounty open, and is live in DevNet for institutional developers to build integrations against before mainnet. That 4th stage in the network's architecture, representing, moving, trading, and now financing value, is the step that converts the $5 billion in represented assets from static inventory to active working capital. And it is in final pre-activation development right now, simultaneously with the most consequential legislative window this space has seen. There is one more technical development worth naming here that connects the Swift modernization story to XRP Ledger's institutional positioning directly. Swift's ISO 20022 messaging standard, which the network has been migrating to globally, has a compliance deadline of November 2026, requiring all payment instruction messages to carry structured data rather than free text. The XRP ledger already supports ISO 20022 formatted payment metadata natively. That standard alignment is not a minor technical footnote. It is the mechanism by which a bank already using Swift infrastructure can route settlements through the XRP ledger without rebuilding its entire back-end messaging stack. The compliance paper trail points to a standards compliant network. The settlement happens in 3 seconds instead of 3 days. The fee is fractions of a cent instead of $25 to $50 per correspondent hop. When the statutory framework catches up to confirm that XRP is the commodity the CFTC says it is, that combination is what an institutional Treasury Department brings to its risk committee as a documented upgrade rather than a speculative bet. Let's be specific about what that window actually looks like because precision here is more useful than narrative. The Senate returns from recess July 13th, coincidentally the anniversary of the initial 2023 court ruling. The National Defense Authorization Act takes the floor first. That leaves roughly 10 working days from approximately July 20th to the August recess for the Clarity Act to be scheduled, debated, and voted on. The bill needs 60 votes, meaning at least 7 Democrats, in addition to all 53 Republicans. And that threshold has been complicated by Trump's $1.2 billion in disclosed crypto income, which made the ethics framework the last genuinely unresolved variable. Galaxy Research has the odds of passage in this window at 50%. Polymarket traders are pricing it at 44%. Both of those numbers reflect specific named variables, not vague pessimism. Whether the ethics agreement gets done, whether the Agriculture and Banking Committee texts get reconciled, and whether the Senate finds floor time around the NDAA. Here is what 50% actually means in this context and why it matters more than most people realize. A 50% probability on a piece of legislation of this complexity and significance is not bad odds. It is a coin flip on a binary outcome. And what changes if it lands on heads is not just a market sentiment shift. It is the compliance documentation question that institutional Treasury departments have been unable to answer cleanly, being answered by statute. The firms that are already positioned with RWA issuance on the network, Ondo, Guggenheim, Franklin Templeton, VERT Capital, do not need to wait for the Clarity Act to continue building. They have already determined the network meets their institutional requirements. What the Act changes is the slope of new entrant adoption. The firms that are currently at the compliance documentation gate and cannot move through it without statutory authority. Think about what that means for the firms in that second category. They are not waiting because they are skeptical of the technology. They are not waiting because they have not run the compliance analysis. They are waiting because their risk committees need a citation, not a memo. The Clarity Act provides the citation, and when it arrives, whether in this 10-day window or in a later session, the new entrant adoption that follows will not be gradual. Compliance gates, when they open for everyone behind them at once. The question that actually matters for a long-term investor is not whether the Clarity Act passes in July or later. It is whether the infrastructure you are watching is the one that institutional compliance departments will point to when the gate finally opens. The current production data says the XRP ledger is already building that case. The signal is clear for those paying attention to the right number, not the price, the institutional deployment. These things run on different clocks, and the institutional deployment clock is already moving. Tell me below, which specific provision of the Clarity Act do you think carries the most weight for institutional compliance decisions? The commodity classification, the developer protections, or the anti money laundering framework? I genuinely want to see where this community's thinking is. If this framing gave you a clearer analytical handle on the thesis, hit like. It helps more people thinking about this carefully find the video. Stay informed, stay positioned. I will see you in the next one.